Welcome back to the Money Pig Podcast, brought to you by Goodwin Investment Advisory, where our mission is to lead people to financial peace, independence, and generosity. I'm your host, Reid Trego, and today on the show, we're joined by certified financial planner Justin Pitcock for a discussion about GIA's 2024 Retirement and Tax Planning Quick Sheet. Welcome, Justin.
Well, let's go.
All right, what are we waiting for? Here we go. All right, this is awesome. So here's the deal. Thanks for being here. It's awesome always to have you here. Tax planning is hard to begin with, but so many things are like indexed for inflation and changed by legislation. Oh, I could sound like Hamilton. I can rhyme. Here we go.
Right.
That it makes it really difficult so for everybody. So we have this guide to make it simpler, our 2024 Retirement and Tax Planning Quick Sheet Guide. And here's the deal. If you're listening and you want to follow along, you can actually go to our website. You can go to our guides, find this, and you can follow along with us. So pause us real quick, run to the website. Okay, we're back.
Download the guide.
Yeah, that's right. Download the guide. Or you can also, if you want to get our blogs, which this has been sent out, you can text blog to 66866. Now, you won't have this guide in your hands in seconds, but that is a way to get on to all of our blogs. So, Justin, we're going to talk about this quick sheet. And it has so many things on here.
It's a lot.
Yeah.
This is a tool that we use as advisors to guide client conversations. And there's so many numbers here that none of us can remember all of them or memorize all of them. They change every year. So this is like a quick reference sheet when we're trying to solve somebody's tax puzzle. But this is the go-to guide.
Yeah,
this is what we pull up.
I still want to read all the numbers.
Oh, all of them?
All of them. Yeah.
I don't know about that.
Okay. We're not going to read all the numbers. Never mind. So we are not going to. We're going to make this marginally interesting. I made a tax joke. That's funny. Marginal tax rates.
Yeah. Okay. We'll get into that.
Okay, we will. But we're going to actually start with some of the things about retirement plans.
Yes.
This is a question people always have.
These are some numbers we'll read off because it's good to know. It's the beginning of the year. You're about to get your first paycheck, or maybe you already have if you get paid weekly. But yeah, it's too late if you get paid weekly because that paycheck's coming tomorrow.
That's right. That's right.
But so the 401k contribution limits increase every year. And so this year, the new contribution limit is $23,000 if you're younger than 50. If you're over 50, it's $30,500. So there's a $7,500 catch up if you're 50 or wiser.
Okay, 50 or wiser. I always love it.
Yeah, if you're trying to max out your 401k, you need to go in there, bump up your contribution rate. And I always suggest that that you, instead of trying to max it out at the beginning of the year, like some high income earners, they're like, I'm going to max it out early in the year. It's going to grow more. Well, not all 401k plans do what's called a true up, meaning if you maxed it out early in the year, you may not be getting the full match. So I just say as a default, just spread it out over the course of the year. Try to max it out if you can, but do it evenly per pay period between now and the end of the year.
So consistent contributions all year long. So you're getting that match at every single paycheck or whatever.
Yes, that's right. That's right. So $23,000 if you're younger than 50, and then it's $30,500 if you're 50 and wiser. So it's the year you're turned 50. So
all right,
it's good.
Perfect.
Good distinction.
Perfect.
Roth IRAs. So Roth IRAs, you can now contribute $7,000. It was $6,500 last year. It's $7,000 this year.
I'm gonna have to redo my math because I knew it was like $651 a month or something last year, and now I got to redo the math. 7,000 divided by 12.
And if you're 50 or wiser, then it's $8,000 this year.
Oh, that's me.
All right. Okay, there you go. So
all right,
$8,000 this year. Let's go.
Okay, 8,000 divided by 12. That seems like it should be easy math. Okay, great.
What is that?
We don't do public math.
Okay, no public math here, but I think it's like a bunch of sixes.
I think it is too.
Yep. Okay. All right. So anything else here? So with a 401k, you've got the money that you put in as an employee. There's the employer contribution. If you're a small business owner or work at an awesome company that likes to do a big profit share, there is a combined maximum that you can put in there. It's up to $69,000 this year. And then if you're 50 or older, you still get that additional $7,500 on top of that. So,
okay. Awesome.
It's a good number to know, but probably applies to very few people.
Right. How about HSAs? I learned something recently about HSAs.
Yes, share.
Do you want me to share it with you? Yep. So max is $8,300 for a family.
Right.
That you
2024.
Contribute for 2024. Some employers actually put a match in for you.
Yes.
So the math would be, this employer I heard about was given a $600 match, $300 in January, $300 in July, or something like that. Nice. And so you got $8,300 for the full year minus the $600 match, and you divide what's remaining there by 12, and $320 a month or whatever the math was.
Yes,
that's
perfect.
Pretty cool.
That's right. It's a combined total. So if your employer's matching together, it still can't go over this $8,300. Now that's for a family plan.
Right.
An individual plan is $4,150, and so we highly recommend HSAs if the high deductible health plan is the right fit for you. We recommend contributing to that HSA because it's one of the most tax advantageous account types that's out there. It's actually more advantageous than your 401k.
Yep.
So it's if you have payroll deferrals, you're reducing your federal income tax, state income tax, your payroll tax, and you can invest that money and it grows tax-free. No other account does that for you.
And when you spend it on medical expenses,
yeah, it's tax-free.
Tax-free.
After age 65, you can use it for other things. However, it would be treated like an IRA or traditional 401k where it's taxable income, but no penalty. So
nice.
Yeah. It's a great advantage. So max those HSAs if you're eligible to contribute, increase your Roth or 401k contributions if you're trying to max those accounts. Don't forget to get that going here at the beginning of the year.
By the way, I just want to say this is a great conversation for the beginning of the year.
Yes.
Too many people, maybe somebody in this room, me, start thinking about this in December.
Yeah.
That's not good.
Nope. I mean, you can, which that actually is a good point because there's a lot of folks in your situation, Reid,
Thank you. Appreciate it.
Listen to this last year.
Yep.
So if you didn't max out your Roth, you've got until April 15th. You can max it out for last year. Last year was $6,500, or you had $1,000 catch-up contribution if you're 50 or older, so $7,500. You can kind of just go ahead and top it off. So I was talking to somebody yesterday, as a matter of fact, and they were in that case. They had an extra little bit that they could put in there, and so we calculated what that was. Boom, just topped it off. And but that's one of their goals. They want to max out the Roths every year,
just like filling up a gas tank.
Yes.
Topping it off.
Yep, top it off.
Awesome.
Let's try to plan ahead and avoid that.
Okay, I appreciate that. All right. Okay, that's on retirement plans. Now, other things that changed for 2024, especially from a federal level are marginal tax rates.
Yes. So let's start with a standard deduction. So that gets increased every year. It's indexed for inflation. So for a couple filing joint, that's $29,200 this year. And if you're 65 and older, you get actually a little bump on that. It's an additional $1,550 on top of that. So that's the standard deduction. When it comes to tax planning, that's important to know because you've got your total income, you've got above the line deductions, pre-tax 401k, HSA, employee paid health insurance premiums. There's some above the line deductions. And then you get to this level where, okay, now it's the greater of either the standard deduction or your below the line deductions, which would be
charitable contributions.
Yes, charitable contributions, mortgage interest, state and local taxes, which are capped at $10,000. So when it comes to evaluating your financial situation and tax planning, the standard deduction is very important. And under the Trump tax code, this is double what it used to be.
Oh, wow.
And it'll be that way this year and next year. Mm-hmm. And we think if Congress doesn't do anything, which we think they're not going to intentionally, it's going to revert back to what it used to be, which will probably mean we all pay a little bit more in tax.
I see.
So when it comes to planning, again, it's total income, above the line deductions, then the greater of your itemized below the line deductions or the standard deductions. A lot of people don't have enough itemized deductions to exceed the standard, so they just take the standard deduction.
Yep.
And so then once you've subtracted that, that's when you get to your taxable income.
And it's funny because I don't think somebody might be listening to this going, oh, I have to decide. Well, probably not. If you're using TurboTax, easy for me to say, or if they're using an accountant or a bookkeeping service to do their tax returns, they're going to make that election for you based on what's best for you.
Yes, exactly. Yep.
Okay.
And so kind of knowing how that plays into effect, we've got to kind of start with your total income, subtract above the line deduction, subtract below the line or the standard deduction. Now we get to your taxable income, and those income brackets are indexed for inflation. So this is a number that we reference pretty often. We think about when we're working with our clients, okay, for example, maybe it's a retired couple and their taxable income's really low, but they've got an IRA. Well, maybe there's some wiggle room here where we can do a Roth conversion and pay zero tax.
Got it. Because that tax rate right there is it's low.
So so if their taxable income was below, let's say they're retired, they're under the age of 65. If their taxable income was below $29,200, we at least need to get their income up to that threshold and convert like IRA money to Roth, so they pay zero tax on that.
Nice.
And anything that spills over is taxed at 10%. Up in the it waterfalls into the next tax bracket if there's more than that. But there's like a $23,000 bracket here where the money that waterfalls into that bracket would be taxed at 10. If it waterfalls into the next bracket, it's taxed at 12, and so on. And knowing the tax brackets here, it's a progressive system, meaning every dollar that falls in the next bucket gets taxed at that rate. It's only the money in that bracket that gets taxed at that rate. So your first bit of money is taxed at 10. After, when you go through this equation we were just talking about with above line deductions, below the line deductions or the standard, then we are at taxable income, and then the income that's in that bracket is taxed, up to $23,000 is taxed at 10. The money in the next bracket's taxed at 12. The money in the next bracket's at 22.
Ooh, that's a big jump. 12 to 22.
Exactly. Yeah, that is a big jump. It's worth noting. Mm-hmm. So when it comes to strategy, are there things that we can do to kind of just keep that next dollar from being taxed at a higher rate? And there's another big jump that's from 24 to 32%.
Yeah.
And so when in the threshold there, where for higher income earners, if you're filing a joint tax return, any income that you have, your taxable income, if it's over $383,900. Yes.
Yeah.
Then that next dollar is taxed at 32%.
That's the marginal rate. The next dollar
marginal is at 32. So you have a marginal rate and effective rate. And when we work with folks that have incomes over this, if it's it could be $50,000 over that threshold, and then they've got above the line deductions, they've got the standard deduction or the greater of, maybe it's their below the line deductions, and maybe we can get them down below that 32% tax rate. Yeah. And so, that's a conversation that we have fairly often where the question is, should they contribute to a Roth 401k or pre-tax 401k? And as kind of general default advice, everybody's situation is different here, but as just default advice, we would say save in a Roth if you're taxed at 24. Mm-hmm. If you're in that, if that marginal rate is 24%, save pre-tax if it's in the 32% rate.
The traditional traditional
401k.
Yeah. Yep. Awesome. That's good advice. That's good advice. I've heard very similar things. So fantastic.
Another, thing that we help folks navigate would be the long-term capital gains tax rates.
Okay.
So just like the income tax brackets, there's tax brackets for long-term capital gains, and there's an opportunity that a lot of people can realize capital gains and pay zero on those gains.
Well, tell us how to do that.
So, I think of like a retiree. They're stopped working. They're living on retirement income. They've got money in different account types. So you have a taxable type. You only pay tax on the interest and dividends or capital gains. You have Roth money. You have pre-tax money. Well, if the sum of your taxable income is below $94,050 this year, any cap gains that were in that bucket are taxed at zero.
Long-term capital gains for which investments for which you've held for at least a year and a day or something, right?
Yes.
Okay.
And so
That's a zero. Great.
Yes, taxed at
Should
zero.
do that.
Yeah. And so, we often are looking at like tax loss harvesting to harvest any losses in somebody's portfolio to offset capital gains. But some people are in a situation where we actually want to harvest gains because we can harvest a gain and pay zero on it. So if we can do that, let's up your basis. There's actually no wash sale rule on harvesting gains.
Oh, really?
So we can sell it, harvest the gain at zero, buy it right back.
Wow, funny.
And
okay.
yeah, so and that's something I think that you could work with your advisor. It's kind of a year-end thing. You know what your income's going to be for that year. They've kind of worked through the calculation. Would it make sense to kind of go ahead and up the basis because you might be in a different situation next year or in the future, right?
Interesting. So, great.
Yeah.
Awesome. Getting smarter. Hold on.
There's one last category that's on this quick sheet that I thought I'd talk about here. It's called provisional income, and it has to do with your Social Security.
Oh, good. I don't know what that is.
This is for retarees.
Oh, good. Okay. I don't need to know what that is yet.
Not yet. But actually, in planning for retirement, you should know. So maybe it's for everybody.
Okay.
So Social Security income is income that can either be taxed or not. And the way the current tax code is written, like we need a plan for that. So if you're not retired, let's decide, let's think through this. Maybe this determines how you're saving your money. Are you putting that in a Roth, pre-tax, or taxable based on knowing the way this works? So provisional income is the amount of other income that's taxable that's non-Social Security income. It's a bit more complicated than that. I'm trying to simplify it here.
Let me ask a question. I think I can ask a question that makes it simpler, because I truly don't understand. So let's say you have a Roth IRA.
Okay.
And you are withdrawing from that Roth. That is not taxable income, so it does not
affect your provisional income.
How about you have a regular taxable brokerage account? You were just buying some Exxon stock or some mutual funds or whatever, and you decide in retirement you're going to withdraw that money. You're going to have maybe some capital gains, and you've had some dividends on it through the year. That is going to count toward
only the amount of the dividend and capital gain. The principal, the cost basis, does not count.
That comes back to you. Okay.
Yep. So that has a low impact on your provisional income.
Great.
And provisional income determines how much of your Social Security gets taxed. So we want to plan in advance that we're going to be in a situation where you have a low provisional income, because if your provisional income is low enough, then Social Security is tax-free money.
Right.
If it's higher, there's this kind of phase out, or I should say phase in range, where Social Security gets taxed. And the largest percentage of your Social Security that is included in your taxable income is 85%. So it goes from 0 to 85% being taxable. And so for those listening that are saving, that's why we generally recommend that you save money in all three tax types. So taxable, like a brokerage account, investment account. You have the Roth money. We love the HSA because it kind of can function like a Roth, basically, because it can grow tax-free if used for healthcare. And then there's the taxable amount. And there's some taxable income that you can realize that is below this provisional income threshold here, which you can have that income and not cause Social Security to get taxed. So for 2024, actually these numbers are not indexed necessarily for inflation, but so if you're married filing a joint tax return, if your provisional income is below $32,000, then none of your Social Security gets taxed.
Great.
As your provisional income gets above that, more and more of your Social Security will be included in your taxable income.
So when you say taxed, so I see if your provisional income is between $32,000 and $44,000, and you're married filing jointly, and they will tax 50% of your Social Security check. That's just like income tax, right? That's not you're not going to pay Social Security and Medicare tax again.
It's just income.
Okay.
But yeah, and it's a gradual range. So it's not, there is a pretty complex formula here. So it's every incremental dollar that's of provisional income that causes a little bit more of your Social Security to be included in your taxable income. So it's a range from 0 to 85% being included in Social Security. And that provisional income kind of threshold is between $32,000 and $44,000 for a couple.
I see.
So that's a number we look at when we're working with a retiree. It's like, okay, when it comes to distribution planning, how much should we pull from that IRA? How much should we pull from the Roth? How much in cap gains should we have? So we want the combination of capital gains and dividends and interest and IRA distributions to be below this provisional income threshold if possible.
Yep.
People who have pensions generally can't do anything about it. If the pension is higher than this provisional income threshold, you're in a situation where it's all 85% is going to get taxed. So
a lot of times that was awesome, and thank you for kind of straightening me out on one of those things. A lot of times people look at investment advisories and they are like, well, they just invest your money, right? You know what? That's a commodity anymore. Literally, you can go to Fidelity, open an account, and invest your money. It's these kind of conversations that make a huge difference.
There's a lot of value here. But I will say, like, our
our models do kick butt. That's true. That is absolutely right. That's very true. The combos were good. But yeah, this is awesome. This is great information. So
there's a lot of value here. We get to know your situation. We look for opportunities, kind of knowing the tax code and where all the different brackets fall, knowing what's relevant to your situation. Our goal is to help you navigate this to pay the least amount of taxes over your lifetime.
Yep. Awesome. Hey, and now for the grand finale, you know what we're going to do? We're going to explain how to calculate required minimum distributions.
We're
not doing that. No way. We're out. That's terrible. That would be awful podcast listening.
Oh, nobody would listen.
No, stop. Turn it off. But yeah, hey, thanks again, Justin. That's awesome.
Yeah.
Really good information. It is. It's always fun. And you can get this at our website, goodwininvestment.com. Search for our guides. You would want the 2024 Retirement and Planning Quick Sheet. That's our guide. It's really great. And then, you know what you could do is you can pull it up, get it, and then you can come back and listen to this episode again because you can follow along with what we're saying. I think that's a good idea. Yep. And just as I was mentioning a minute ago, this is as financial advisors, we manage and rebalance portfolios and build portfolios.
Trying to keep it clean here.
But the unique values that we work to understand our clients' individual goals so we can have these exact types of planning conversations that are so personal and unique to each individual. So thanks again for being with us, Justin.
Yeah, it was fun.
Right on. And thanks for listening. We will catch you next time. Bye.
The Money Pick podcast is hosted by Reid, a financial advisor at Goodwin Investment Advisory. This podcast is intended to share information and perspectives, but should not be interpreted as legal, financial, or tax advice. The opinions shared by participants are not necessarily endorsed by the company. Goodwin Investment Advisory is regulated by the SEC, and the company operates in compliance with applicable securities laws and regulations.